Okay. Hello, ladies and gentlemen. How are you? I hope you're fine. Wherever you are, guys. I am Jerry Mtunkuli, and I welcome you all to this presentation where we are going to look at two questions uh, in this week's exercises, which I think if you flow with me or if you follow me, I think it will be much easier for you to attempt the rest of the questions on your own. Okay, those are my numbers. If you feel like you want to engage me as your tutor for this ACCA paper or any other ACCA paper which you are studying, please contact me on those numbers. You can contact me through call or through WhatsApp, also through email. You can contact me as well. All right. Um, tinoda zvekurova basa vakomana ndo zvatinoita tinotamba neaccounts. So if you have got a relative or a friend in need of tutoring or in need of a tutor, please feel free to refer them to me. They will be in safe hands. All right. So investment appraiser, oh man, this is part of financial planning discipline. Okay, we need to appraise an investment before we commit our funds into it. All right. So in other words, uh, it's part of uh, the agent's theory. Okay, we look at uh, the I mean an attempt to solve what is called the agent's problem. All right, to solve uh, the notorious urgency problem. What is the urgency problem? The urgency problem emanates from the fact that uh, companies are owned by shareholders, right? They are owned by shareholders. However, these shareholders are not the ones who are going to manage the companies. All right, so they hire individuals called directors. These directors are agents of the company. Okay, so we have got the owner. The owner is the shareholder. All right, but then this guy hires what is called the agent, who is the director. Okay, the owners work shareholders are also called the principals. So principals hire the agent, all right? But now the problem is these guys have got various or varying objectives, all right? Principals want to maximize wealth, okay? They want to maximize their wealth, but these guys, they also want to maximize their own wealth, all right? So you can see that there could be some conflict of interest. All right. So the financial planners or the proponents of financial management, they come up with this idea of investment appraisal just to help these managers or directors to ensure that they invest the shareholder funds in an appropriate way. Okay, so investment appraisal, these are just the techniques to ensure that the funds of the shareholders are going to be used where they are going to yield shareholder maximization, wealth maximization. Okay, so that's the idea in brief. All right, but now the purpose of this lecture is just to, I mean, to attempt two questions so that we, you know, um, push the point home, okay? Or we actually help to ensure that this idea of investment appraisal is well grasped, okay? So you see with these questions, we'll be having a scenario where the examiner will give you the background. Uh, don't worry about the complexity in terms of the specialization of the company's industry. I mean the hypothetical company's industry. Sometimes the examiner say, "Oh, this company is into cosmetics, or it is into medicine, or it is into the manufacture of a sophisticated chemical." Don't worry about those things. Okay, the examiner would just want to create a good atmosphere for you to feel at home. Okay, but for the purpose of this paper, they do not want you to have a certain background for, I mean, of a particular industry. You don't need to be a nuclear scientist for you to attempt a question related to nuclear production. Okay, you don't need to be having such a background. All you need is to have your financial principles. Okay, financial management principles. So let us uh, attempt this question. Okay, we've got a company called Bora. Okay, Bora Berry, Bora. Okay, Bora, Bora, guys. All right. So we are having a company called Bora Co. All right. This company has developed a new confectionery line that can be sold for $500 per box, and that is expected to have continuing popularity for many, many years. The finance director has proposed that investment in the new product should be evaluated over a 4-year time horizon. Remember, the name project, when we are saying project appraisal or investment appraisal, we are simply saying that, oh, you need to put across, as a finance manager, you need to put across your facts to the board that this particular investment we want to venture into has got this time period. Okay, we are expecting to yield substantial results within this time horizon. Okay, so in this case, the finance director is saying, "Oh, this investment is going to be, if I mean, within a 4-year time period." All right. However, sales might continue after the 4th year, but uh, those cash flows are not certain. Okay, so this is why we are having a statement whereby even though sales would continue after the 4th year, on the ground that cash flows after 4 years are too uncertain to be included in the evaluation. So it doesn't necessarily mean that after the 4th year we're not going to receive certain sales or certain incomes related to this project. Yes, we're going to receive them, but they won't be that significant. Okay, so we can't include that extra period for our evaluation. The variable and fixed costs, both in current terms, would depend on our sales volumes as follows. Okay, so this is the information for variable and fixed costs. All right. Now, forecast sales volumes are as follows. So these are the volumes for sales. Volume. So in the examination, you can annotate where possible or to shed or to highlight so that you will remember when you will be answering the question. Now that we have read a bit of the question, or let me just say half of the question, it is advisable for you to go straight to the question requirements, so that you know when you will be finishing the whole scenario, you would be knowing where to attack and what is being required. Sometimes in the examination, there won't be so much time for you to read like a storybook. All right. So required A, assuming that production only lasts for 4 years, calculate the net present value of investing in the new product using a nominal terms approach and advise on its financial acceptability. Work to the nearest $1,000. All right, so 13 marks, ladies and gentlemen. 13 marks. Those, remember, in ACCA mark, for you to get a mark in an ACCA examination, you would have sweat. Okay, you would have sweated. All right, so you need to fight your nails off to ensure that you won't miss a mark. Okay, it's not very, I mean, it's not actually easy to get a mark, but you just have to stand on a principle so that you get those marks. You can't afford to lose any mark, especially when it comes to an investment appraisal question. These are actually takeaway questions in this paper. All right, so you just have to have your template in mind on how to attack any investment appraisal question. All right, please refer to this week's lecture notes and lecture video for you to understand further on this subject. All right, now we are told you need to assume that the project lasted for 4 years. All right, and you need to calculate the NPV. All right, and you need to use the nominals approach. Okay, nominals approach. This is an issue of the Fisher theorem. Okay, the Fisher effect or the Fisher theorem. All right, where we are saying the nominal rate is 1 plus I. Okay, I'm sure you remember this formula, which is equal to 1 plus R, that is the real interest rate, multiplied by 1 plus the inflation rate. Okay, but in this case, we are told, I'm sure, that the nominal after tax cost of capital is 12%. So you don't need to calculate this because it has been given. Okay, the nominal rate has been given, so don't worry about the Fisher effect formula. Okay, just ignore it because the examiner just say use the nominal rate as given. All right, so you can finish the question. The production equipment for the new confectionery line would cost 2 million. So this is your initial investment. Okay, the investment that is required, and then an additional initial investment of 750,000 would be needed for working capital. So this is an additional initial investment. All right, and we are saying this additional initial investment is actually called the working capital investment. All right, it has got its own politics in the way in which it is being treated. Okay, in which it is going to be treated, it is separate from the original or the initial investment. Tax allowable depreciation. Tax allowable depreciation on a 25% reducing balance basis could be claimed on the cost of equipment. All right, so we are allowed by the tax authority to deduct 25%. These are called capital allowances. Okay, this is common in many jurisdictions worldwide. That whenever you buy a capital asset, you then have to deduct some. You need to enjoy some tax depreciation. Okay, you're allowed to deduct those costs on a systematic basis, in this case on a reducing balance basis. All right, so such reduction attracts some tax savings. Okay, there are some tax savings within those deductions. Okay, because we are only, interested in the tax benefit of that deduction. All right, the tax benefit, that's the relevant cash flow there. All right, remember in investment appraisal, we are furthering the concept of relevant cash flows. Okay, only relevant or incremental cash flows are to be considered for the tax benefit. That's our relevant cash flow when it comes to tax allowable depreciation. Okay, profit tax or income tax of 30% per year will be payable 1 year in arrears. This is a very, very important point. 1 year in arrears, which means if you get the tax benefit for this year's cash flow, okay, if you get some tax saving for cash flows for this year, that benefit is assumed to be enjoyed in a coming year or in the coming year, not the current year, but the year that follows. A balancing allowance would be claimed in the fourth year of operation. The average general level of inflation is expected to be 3% per year, and selling price, variable cost, fixed cost, and working capital would all experience inflation of this level. So with this type of wording, you would be tempted to actually go back to the Fisher formula and try to calculate the real rate, okay, the real rate for the purpose of discounting. However, the examiner has actually pointed, okay, that um, you must use the nominal, okay, that's the very important term there, the nominal terms approach. So if the examiner has actually told you explicitly that you need to use the nominal approach, why then do you put it upon yourself to do otherwise? Please, Vakomana unonyura. Okay, so you need to, try to follow the rules. All right, now let's do the working and see if we can make sense out of this presentation. Okay, like I said, you need to have the general understanding of these NPV issues. Okay, you need to have, like for example, it's an issue of having the year, right? You have your year, you have your usually you have your year 0, you have year 1, year 2, year 3, year 4, and then you can have year 5. Why? Because even if in the examination you are just rushing, it is actually safer to have some buffer space. All right, these days is very simple because it's now a computer-based examination, and you'll be doing all these things in Excel. So when you're doing it in Excel, obviously the issue of space is not going to be an issue, okay? Because Excel is very flexible in the adding columns and so forth, adding or deleting or formatting them anyhow. That is not going to be a challenge, okay? But like I said, here you'll be calculating, the NPV template is usually generic. Sometimes, the computations follow the same criteria, okay? We need to know the initial investment, we need to know the cash flows, all right? The cash flows. So like in this case, we need to know the inflow and outflow. So usually we start with the outflows, which we call the initial investment. All right, for example, in this case, the initial investment, we are told that it was 2 million. Okay, so you can actually tell your examiner that these figures are going to be in thousands. Okay, thousands. So our initial investment was 2 million. Okay, that was the investment for the cost of this capital asset. All right, and we were told also that they were going to incur additional initial investment of 750,000, which was the working capital investment. Okay, so sometimes you may disregard, or let me just say, you may not worry about the initial investment in your computations because it's actually even wiser to deal with the initial investments last, okay, because they might confuse you, because that column is not uh, going to be, there's no need to discount it actually, because it won't change anything. You just have to multiply by one those figures and you get them as they are. So usually it's better to just forget about them initially when you do your computations, and then worry about them later. All right. But anyway, let us work with them in this column. That's normally the standard in main textbooks. All right. You have your year zero figures, and then your year one, and so forth. This way they were common. All right. Now let's think of. So this one is actually an outflow, right? It's in bracket. Why? Because it's an outflow. Let's think of the inflows, right? The inflows. The inflows, we are given information about the sales, all right? We are told of the sales. Um, we are told of the VC, the variable costs. We are told of the fixed costs. Ladies and gentlemen, in relevant cash flows, normally fixed costs are not considered. Why? Because they don't change. However, if they are directly linked to the particular project or investment, if they are directly linked to the uh, I mean carrying out of that particular project, then we consider them. But if they are just general common overheads, not specific to a project, we then have to ignore them. Again, if these fixed costs were incurred or are just sunk costs, they are already incurred, we normally refer to them as sunk costs and we ignore them. So those are the techniques, but you just have to be very vigilant. So these fixed costs are assumed to be very relevant to the project. Okay. All right. So let us now, because there is an aspect of inflation and so forth, we then have to say, because each box is being sold for $500. So we then have to worry about how much boxes were produced in year one, year two, and so forth. And here we are getting the information about those boxes. In year one, they were 0.7 million. Year two, they were that. So these are the figures we will be working with. Okay, those are units of boxes. So you will see that we require a separate space for workings for us to be very systematic. Okay, so for the workings again, we also need the same column: year one, year two, year three, year four, year five. Okay, all right. So we start with the sales. The volumes in year one, I still remember it was 0.7. Okay, this 0.7, it's 0.7 million. So if it is million, then we can just say 700,000 for the purpose of our computations. Okay, and then year two it was 1.6, 2.1, 3 million. All right, so those are the figures. All right, so 1.6, okay, 2.1, 3 million. So those are the figures. All right, and we are told that each box is going for, the selling price was 500, but we are told that there is inflation. Okay, there is inflation, and the inflation is 3%. Okay, so to inflate, we then have to say we have to multiply the amount to be inflated by 1 plus, remember the Fisher formula. Okay, that's we're going to multiply the 500 multiplied by 1 point the rate. Okay, it's 1 plus 0 0.03. Okay, so that's 1.03 to the power. Now the power is the year, to the power n. N is the year, to the power n. All right, to the power n. Okay, to the power n. Okay, n. So for example, in year 1 we need to say 500 multiplied by, for year 1, let me just write it down because some of us do not actually see these things. For year 1, for year 1 it's 500 multiplied by 1.03 to the power 1. Why? Because that's year 1. Okay, so let's punch that figure. Let me use my calculator as well here. 500 multiplied by 1.03 to the power 1. Okay, what do we get, guys? I got 515. And what did you get? Okay, okay. Right here I want you to be with me. There has been a typo, okay, because it won't make sense that um, the unit selling price is 515 versus versus uh, the total cost. Let me just say the total cost of say $3.80. Um, I mean, the variable cost per unit is actually $2.80. So you see that I mean $2.80. So it won't make sense actually to say the selling price is $500 versus I mean the unit selling price is $500, whereas the variable cost per unit is $2.80. I mean it doesn't sound much convincing. So this is just a typo. The selling price should be $5 here. Okay, please bear with me. I note that error, right? So let us work with selling price of $5 per unit or per box. Okay, $5. Bear with me there. So in our computation, we then have to consider this one is $5.15. Okay, so this is $5. $5 multiplied by 1.03 and we get $5.15. All right, so for year 2 again we say $5 multiplied by 1.03 to the power 2 now. Okay, for this part here. All right, and let us use our calculators and see. We get 5.305. We do the same for year 3. We get 5.464, and for year 4 we get 5.628. Now one might be asking, say, how could you do those computations so far? It's very simple. All right, all you need, if you have got the sharp DAL, or usually many scientific calculators, if you say $5 multiplied by 1.03 to the power 1, all right, you get say $5.15. Then you just have to say this multiplied by 1.03. Okay, you get your 5.305. Then you have to just say multiply by 1.03 again. All right, and you get these figures easily. And then maybe the third after the third punching of the 1.03, you just have to say equal sign, equal sign, equal sign, and these figures would come until you reach the level you want. All right, so it's very, very, very simple. You try that, just try that, and you see that the calculator technology is actually advanced more than you think. All right, let's continue with our computation. So now we have put the selling prices, the inflated selling prices. These have been inflated now. We then have to go to totalize and get the total sales figure. So you just have to totalize here. All right. So you get your totals. Now, I mean your products. For example, 700,000 multiplied by $5.15, you get a certain figure there. What is the amount? That's 3,605. Okay, remember these are in thousands. Okay, these are the sales. Okay, sales, they are in thousands. Sales in thousands. All right, and then we have got 8,488. Then 2.1 multiplied by 5.464, we get 11.474. We go to 3 million multiplied by 5.6 to 8, we get 16.884. Okay, so that's the sales information. We then move on to the variable cost element. Let's calculate our variable costs. These were the sales. Now for the variable costs, again we can consider the sales. All right, if we had done this in Excel, in the next question we will do this in Excel, and you see that it's very simple if you do it in Excel. Okay, so let us just finish this one, and then we do the Excel way. All right, we know the volumes as usual. The volumes are 700,000, year 1, 1.6 million, 2.1 million, 3 million. Okay, and the variable cost per box, VC per box. The VC per box, this one was $2.80, and we are told that there is an inflation of 3% to consider. So that's $2.80 multiplied by 1.03 to the power n. And in our first year, okay, let's visit the wording of the question first. For this variable cost, the average general inflation is available to be 3%, okay, and per year, and selling price, variable cost, fixed cost, and working capital would all experience inflation of this level. Okay, so $2.80 multiplied by 1.03 to the power 1, because in first year that's to the power 1, so we get $2.844. Okay, $2.884. All right, and then if we multiply this one by 1.03 to the power, I mean this time you don't have to say to the power because you're multiplying you multiply this one by 1.03, so you just have to say 1.03 and don't put any power, and we get 3183. Okay, and then you multiply that one again by 1.03, you get 3.278. You multiply that one by 1.03, you get 3.433. As simple as that. You underline, you get your variable cost in thousands. And what you get here 700,000 multiplied by $2.884. That's 2019 2019. 1.6 million multiplied by 3.183. That's 5.093 million. Then 2.1 million multiplied by 3.278. That's 6,884. Excuse me. Okay. 3 million multiplied by 3.433. That's 10.299. Okay, we're done with the variable cost. Let us now do the fixed cost, so our table can continue as far as we want it to. So let us extend the table columns. All right, this time we are looking at the fixed costs. All right, we are also going to be guided by the sales volumes. Remember, this is year 1, year 2, year 3, year 4. Okay, these are the years. Ladies and gentlemen, do not be confused. All right, now the year 1 volume was 700,000. This was 1.6. These are millions, remember. And K stands for thousand. 2.1 and 3,000 K. All right. Now the fixed costs were given. The fixed costs were given in total. All right, they were given in total. All right, so we just have to slot the figures given, the total figures, because remember here you can see that the variable cost was per unit, it was per box, but this one now is the total fixed cost. All right, so we need to match like and like, right? So in this case, that's what we are going to do. Okay, now if you guys are following, you could see that as I've indicated, that we need to match like and like. That means we need to be guided by the principle. Okay, we are saying here the fixed costs are being given in total. So for the year 1, it was 1 million. Okay, and year 2, according to the equation, year 2 is 1.8, year 3 2.8, and year 4 3.8. So let's slot in those figures. 1.8, okay, for the fixed cost in total. 2.8, and then 3.8. Okay, And remember, these are in $1,000. Now, my question is, uh, do we have to inflate these fixed costs? The answer is yes. So, inflated. The inflated, we are going to use the 1.3 to the power n as the inflating factor, or the inflation factor. Okay, 1.3 to the power n. So which means we are going to multiply the figure by 1.03 to the power n. So in this case, okay, let us just try to underline here. I'll tell you why we have underlined that part. So 1 million multiplied by 1.03, we are going to get 1 point. These are not points. Remember, a point is a 0. Okay, so I'm putting those commas for you to see what is going on. All right, so it will come as 1030. All right, and then 1800 multiplied by 1.03, and this time it's 1800 multiplied by 1.03 to the power 2, or you can just say 1030 multiplied by 1.03, and as we did in the initial, in the preceding computation, and you are going to get 19910, and then multiply by 1.03 again, you get 3.060, and then 4277. Okay, now my question is, isn't that the figure which we need for the fixed cost? The answer is yes. Those are the figures we need for the fixed costs. So these are the inflated fixed costs, right? So those are the figures you are supposed to check. You don't need to multiply. This is why I put an underline here. This underline. I've underlined here for you just to see that these figures are just related to the volumes of 700,000. This one to the volume of 1.6 million. This one 2.1. This one 300,000 volumes. But the fixed costs are just going to be these totals. No need to multiply. If you multiply these totals by the volumes, you're going to have a wrong figure. Okay, and the examiner would see that this student is still not yet ready to go to the other level. Okay, so those are the figures which we are going to check. So we've got the figures for the fixed cost, these are the figures for the variable cost, and the figures for the sales. All right, another working we need, of course, there's the working for taxation. Okay, as you can see in the question says this company is allowed to deduct tax depreciation. So that tax depreciation follows the reducing balance method at 25% rate. So let us come here and do the tax computation. Taxation. Okay, now the taxation also follows our column. All right, we can make use of our column if you want. But you just have to know how to use these columns, because if you are not careful, remember the tax benefit is going to be enjoyed 1 year in arrears. So when you extract information from this column to the appropriate NPV, because remember these are workings, we need to extract these to our tablet, the NPV tablet. Okay, so This is year 1, year 2, year 3, year 4. All right. All right. So we are told that these guys. All right. So let's calculate the tax allowable depreciation. The third, okay, tax allowable depreciation. We are told this equipment was bought at 2 million. All right. Okay. The cost is 2 million. Okay. 2 million. And we are allowed to deduct 25%. So the first, in our first year, we're going to charge 25%, all right, of 2 million. That's 500. Okay. And then in year 2, we are going to charge 25% reducing balance method. So what we are going to charge in year 2 is 2 million minus 500 multiplied by 25%. And what do we get? That's 1.5 multiplied by 25%. 1.5 multiplied by 25%, it becomes 375. That's year 2. Then in year 3, we're going to say 2 million minus 500 minus 375 multiplied by 25%. So that's 2 million minus 500 minus 375. We get 1125 multiplied by 25%. It becomes 281. We do the same for the 4th year, and we must get 843. Okay, you may put this because here the examiner might be angry if you ignore those decimals. Okay, I'm sure you found how we did it. Okay, for the 4th year, somebody might be asking and saying, how did you get that? Okay, no problem. Minus 500 minus 375. Okay, minus 281.25 multiplied by 25%. All right, let me try to put arrows so that you guys won't be confused. We are saying for the 1st year, this one for the 2nd year, this one for the 3rd year, this one for the 4th year. Please, you can replay the video until all this has been assimilated, has sunk within you. All right. Now, in the examination, do you need to do this? This laborious, this long route. Do you need to follow this long route? Obviously not. Okay, you don't need to do this. You don't need to do this. So what do you do? What do you have to do? All right, the easiest way is, I'm sorry, I'm taking your time, but this is the easiest way for you to calculate these tags. We know that the cost, as usual, was 2 million, and we are allowed to charge 25%. So initially we say multiply by 25%, and we get our 500 in year one. This is 500. But for year two, we just only have to multiply by 75%. So we just say 500 multiply by 0.75. We get 375. Multiply by 0.75. 375 multiplied by 0.75. We get our 281.25. Multiply by 0.75. Um, our 210. Okay. All right. We get to 10.93. Okay, bear with me. All right, I also forgot to explain that. Okay, now we know that the cost of the equipment is 2 million. Okay, that's the cost. Now we are allowed to deduct these tax depreciations on a systematic basis. However, we are told that a balancing allowance has to be sustained at the end of the project. Okay, there is this statement that a balancing allowance would be claimed in the fourth year, which means the total cost of the equipment has to be subject to the tax, to taxation. So the total cost is 2 million. However, for the first 3 years, we had deducted 500 in the first year, 375 in the second, 281 in the third. But we still have the balance up to 2 million. So we can't deduct this 210. Okay, in a multiple choice scenario, you would have failed if you put 210 as your deduction in the fourth year. Your deduction should be the balance. So you need to add up 500 plus 375 plus 281, and you get a total of how much? So let's do that. 500 plus 375 plus 281.25. You get 1156.25. You then have to deduct that amount from 2000, and you get 843.75. This is the balancing charge. Okay, the balancing charge or balancing allowance. All right, for that. So that's how the 843. So here I had forgotten to say that you need to consider as well. You need to let me try to rub off, okay, this part. I'm sorry for that. I'm sorry. Okay, that's 2 million minus, in bracket, 2 million minus 500 minus 375 minus 281.25 in bracket multiplied by 25%. So you see that this was actually a very laborious and long route. Okay, so the shortest route, you just have to, after you do your 25% on the initial year one, 25% of the cost, that's 500, and then you just have to multiply the figures by 75%. If the rate was 20%, You first obtain the 20% deduction for year one, and then you multiply by 80% until you then have to reach the last year, and then you just put the figure there. However, as I have indicated, these are not relevant cash flows. Okay, the relevant cash flow was the tax saving. Tax saving or tax benefit. So the tax saving is that we need to multiply these deductions by the tax rate. The tax rate was 30% according to the question. Okay, let me cross check. Yes, so the tax rate is 30%. I'm sorry, I have annotated the question to an extent that you can't see clearly, but I hope you will bear with me. All right, so for year one, okay, for this year, we're going to say 500 multiplied by 30%, we get 150. That's the benefit, ladies and gentlemen. That's the tax benefit. Then 375 multiplied by 30%, that's 112. Okay, 5. Remember, these figures are in thousands. All right, these are in thousands. Then for year 3, 281 multiplied by 30%, that's 84.375. And then in year 4, that's 843,750 multiplied by 30%, that's 253.125. Okay, so these are the figures we are going to take to our NPV table. Lastly, we need to worry about the working capital. Okay, the working capital, ladies and gentlemen, we know working capital is an initial investment. According to the question, it was an additional initial investment. So we've got year 0, year 1, year 2, year 3, year 4. Okay, so the working capital was 750,000 according to the question. Okay, was 750,000. Now, you may be tempted to put this figure in bracket in year 0 in the working section. That might end up confusing you. So don't put a bracket. It is an outflow, yes, we know, but for the purpose of working capital calculations, please don't put the bracket there. Just hang on, hold on. Okay, now we are told that this working capital is also subject to the inflation. The inflation was 1.03. So let us multiply 700. I mean, the inflation rate was 3%. Okay, but for us to inflate this figure, we then have to say 750,000 multiplied by 1.03. And what do we get? 750,000 multiplied by 1.03, that's 772,500. We then multiply that figure again by 1.03, we get 795,675. We multiply that one by 1.03, we get 819,545. Okay, all right. All right, now that's the first line of defense, but that's not the answer. The answer is the incremental cash flow. Okay, the incremental cash flow, right? So incremental, the incremental working capital. All right, since this amount was put in year zero today, we it doesn't, I mean, it's not relevant for us. What is relevant is actually the additional working capital, all right? The additional component. Of course, it is relevant in such a way that it is going to be, it is a negative cash flow, right? We need to recover it at the end of the period. So the recovery at the end of the period is actually the relevant cash flow. And that is always going to be equal to the last cash flow, right? So we're going to recover it. So this last cash flow is going to be recovered 89545. We need to recover it at the end of the project, all right? We need to recover that. However, in between the relevant cash flows are the differences. The differences, those are the relevant ones. So in year one, the difference is 750 minus 772.5. The difference is 22. Okay, 22,500. And 700. 772,500 minus 795,675. The difference is 23,175. And 819,545 minus 795,675. The difference is 23,870. So these are the relevant cash flows. Those are the cash flows we are going to take to our table. So let us finish the table, ladies and gentlemen, as quickly as possible. We have spoken so much. So our sales are going to be taken from these figures. We've got 3,000. We've got this one, we've got this one, that one, and that one. Okay, so those are the figures 3605. All right, this is in year one. Okay, this is in year one, 3605. All right, let me use a black pen. It's much visible. 360. 3605. Year two, we are talking of 8488. I still remember. Yes, and 11474. And then 16884. Those are the sales figures. Now for the variable cost, we have got these are now in brackets because they are outflows. 2195093 on 6884 10299. Let's cross check with our initial computations on the workings. Then for the fixed cost, for the purpose of our time, 1030 1910 3060 4277. Okay, you can cross check. You see that these figures are the ones we have here. Variable cost, fixed cost. All right, let's get totals for the taxable cash flows. So if we up add up to this point, we get what are called taxable cash flows. Now, if you use these terms in the examination, the examiner will be happy and he will say, my kid is ready for the next level. If you just use English terminology, you're not going to, you will be putting yourself at a disadvantage because you'll be failing to convince the examiners that you are ready to become an assistant finance manager. Because remember, this paper is preparing you for those positions like accountant, assistant accountant, and so forth, or finance manager or assistant. So you need to show some bit of, alacrity. And zero, man. Okay, so let us add up these figures to get our taxable cash flows. All right. Okay. 3,605 minus 2,000 minus 1.03. We get 556 1485 1530 2308. Now, after we get our taxable cash flows, the next thing is the taxman will just say, hey, pay me my dues. So tax or taxation, okay, the tax. Now, the tax is at 30%. So multiply the taxable cash flows by 30%, and we get, for example, 556 multiplied by 30%, we get 167. And this benefit, this charge is going to appear in arrears. It is for year one, but it is going to be put in the second year. Okay, the second year, because we are told that the taxation is paid in arrears. So any relevant benefit will also be enjoyed in arrears. So this is a charge. It is put in bracket. So that's where we get, it's from 556. Now we then have to multiply 1485 multiplied by 30%, and we must get 446, and we put it in brackets. We do the same, 1530 multiplied by 30%, and we get 459, and we put it in brackets. Then 2308 multiplied by 30%, we get 692. Saka ndokutorova bhora racho mberi ikoko kwaunenge uchitoita. Let us move, guys. Let us move. Now, it is better, it is encouraged, and it is the standard global practice that when you do your taxation, you just have to put your taxation at the one place. So here we have considered the tax charge. Why not also consider the tax benefit? So we come here and say tax benefit or tax saving from our workings. Okay, you can tell the examiner this is from the workings. So these ones were workings. Okay, you can actually put the working number. Okay, for example, the sales, you can say this was working number 1, this was working number 2, this was working number 3, and this one working number 4, and so forth. All right, but make sure those numbers are also going to appear on your workings. Otherwise, you would confuse yourself. Okay, so the tax benefit is working number 4. Okay, all right, let us just label that for the purpose of my student. All right, so this one, the sales was, you can just say number 1, right? And you can also put this one, this was for the variable cost, or you can as well put your numbering on headers. For example, all right, sorry, Okay, you can just say here, number one, sales. You underline. You come here and say two, variable cost. You underline. Then three, fixed cost. You underline. Then four, working number four, sorry, four, taxation. So here I was now having some order, and then this one being working number five for the working capital. This shows some sense of maturity and organization. You will be a person who is organized. Now the tax benefit, ladies and gentlemen, we've done the computation. So let us just take those figures and slot them to that row. So we've come to the taxation workings, and the figures we want are the tax benefits. These ones. Okay, so we start with 150, 112. But remember, those figures are in thousands. So we come here and say 150,000. But we have already indicated at the heading there that these figures are in thousands. So just check the figure as it is. Right, but do we put it in year one? That's the confusion. We don't put it in year one because the tax is being paid in arrears. So therefore, the benefit should also be enjoyed in arrears. Okay, so that's the mistake. You can see that I also fell into the same trap. Okay, so that's a very, very common mistake. Then we also found 113, we found 84, we found 253. Ladies and gentlemen, I've just rounded up. Okay, after we do this, we then have to slot in the working capital. Okay, now for the working capital, ladies and gentlemen, you need to be with me. Working capital does not follow the taxation. Working capital is just follows the normal the normal figures. Okay, it doesn't follow the taxation rules. Okay, so it follows the year in which it was incurred. All right, so for year one, we just pick the working capital incremental figure relevant to year one. So sorry, we had found that in year one the relevant figure was 22.5, year two 23.2, and so forth. We can just round up to thousands as required by the examiner. So instead of 20.5, we can just say 23, and then here we can just say as well 23. There, that's 24, and so forth. All right, that's the rounding I'm talking about. So we come here and say 23, 23. Okay, but incremental simply means that we incurred further working capital. So if we incurred further working capital requirement, this is an outflow, this is an outflow. Okay, and we said here that's 24, it is also an outflow. But at the end of the project, we need to recover the money. So if we are recovering the money, it means the 800 we are going to recover is actually going to be a positive figure. Okay, in our working, it was a negative figure, remember? This one, 819.5, that's 820. Okay, we are going to put it as a positive figure. Please replay this video over and over again. All right, if you don't want to commit suicide in the examination, please replay the video. And better still, don't forget to subscribe to the channel if you haven't yet subscribed to it. Okay, and share the video with your friends and so forth. Now we have done much of the workings. Let us now do the totals, and we get our after tax cash flows. After tax cash flows. So 556 minus 23, we get 533. Okay, 1485 minus 167 minus plus 150 minus 23, we get 1445. Here we get 1173. Here 2753. There minus 692 plus 253, we get 439 negative. Okay, then we do our discounting factor at 12%. Okay, 0 point. Okay, in year one is always 1. All right, for in year 0, the discount factor is always 1. Okay, the discount factor is always going to be 1. And also remember that we have incurred working capital. Okay, the working capital was 750. This is a negative figure. Okay, we need also to put that one into that column, the year 0 column. So the discount factor at 12% year 1 is given by 1 over 1.12 to the power 1. Okay, if you punch this figure, you must get 0.893. Okay, then if you divide this figure by 1.12, you must get 0.797. And if you divide this by 1.12, you get 0.712. If you divide this, if you divide this by 1.12, you get 0.636, and so on and so on. And if you use your calculators, once you follow the same pattern twice, you just have to say equal sign, and those would be coming out naturally, automatically. I'm sorry, but I'm just being selfless. I'm just doing my best to ensure that you guys get to grips with this computation. Okay, you mustn't face challenges when your tutor is by your side. Okay, we are together, isn't it? All right, so once you do this, once you've done this, then you have to underline and get your present values. Okay, so in the first column, for year 0, we've got minus 2,000 at the start there as initial investment, plus minus 750, we get negative 2750. Okay, then okay, here we should have actually done and put the 2750 on this. Okay, because if you multiply this one by 1, we get 2750. That's okay. Then 533 multiplied by 0.893, we get 476. Then 1445 multiplied by 0.797, that's 1152, and this one is 835, 1751, and negative 249. Now if we add these figures across, if we add all the figures in that row, we get our NPV. Okay, the NPV, ladies and gentlemen, is a positive 1,215,000. Now, what is the comment then? Because by the end of the day, you need to comment. After you have done your computations and you've obtained your NPV, whether it is positive or negative, then you have to make a comment. And you must have to say the proposed investment in the new product is financially acceptable. Why? As the NPV is positive. The NPV is positive. This is why we are saying you need to accept this investment. Okay, so in the eyes of financial managers, the project is acceptable. So this is why we are saying it is financially acceptable. There could be some other politics that might cause us not to accept the project, or some other reasons. For example, the project, although it is financially acceptable, it is not good for the betterment of the society. It is a social wrong, so we can't allow its commencement or its execution. So those won't be financial considerations. Those would be other business considerations which would need other managers to put their input or to give their input. So that's how we do the computations, ladies and gentlemen. The other part of the question was saying, discuss 3 ways of incorporating risk into the investment appraisal process. Yeah, this one is actually a discursive part of the question, where you need to show your acumen, your financial literacy, financial management expertise. Okay, there are a lot of techniques which we might employ to ensure that we have incorporated the aspect of risk. Okay, we might use what is called sensitivity analysis, where we consider the potential outcome if a certain variable has been put into perspective. Okay, what is going to happen if the selling price is increased? What is going to happen to the NPV? Okay, if the fixed costs are no longer, if the fixed costs have become semi-fixed, okay, if they change color, right, if they have been diluted, what is going to happen? All right, so that's the aspect of sensitivity analysis. Okay, then we may use probability analysis. Okay, here we will be looking at issues like statistical quantification of results. For example, we have been saying that the selling price is going to be $5 per unit. or per box. But what is the probability that 700,000 boxes are going to be bought at $5? So we'll come up with a range of probabilities. For example, there is a 90% chance that at $5, 700 boxes are going to be bought. But there is also a 10% chance that 20,000 boxes are going to be bought if the selling price becomes $6. So that's the idea of probability. All right, so we come up with a range of probabilities for certain variables. Then we can also use things like adjusted payback, all right, risk adjusted discount rates, and so forth. So there are many techniques which can be employed by financial managers to ensure that the aspects of risk have been put or have been considered in investment appraisal. Okay, right. Okay, that is that, ladies and gentlemen. I hope to see you in the next part of this video where I'll be showing you how to do these things in Excel, because the type of examination we are likely to face is a computer-based examination where you'll be given an answer portion that require you to use the Excel spreadsheet. So that being said, let us meet one another in the next video. Okay, I'm trying to look at okay, it doesn't matter.